very good morning, ladies and gentlemen. I request the ones at the back and the ones I can still see outside the door of the hall, please join us back into the hall. We now begin the TIOL Tax Congress 2022. So very good morning. I'm Ritika Jhanji-Chakhtiyani, and on behalf of TIOL, it is an absolute pleasure to welcome all of you to TIOL Tax Congress 2022. I think now that we're all here, nice, early, bright in the morning, how about kick-starting the show with a good round of applause? I'm sure each one of you who's present here in the gathering knows that over the last 23 years, TIOL has managed to become a credible leader in the online resource provider space, bridging the much-needed communication gap between policy making, policy interpretation, and policy implementation by dissemination of business-critical information through expert views, analysis, and a lot more. And just as we promised last year, we are back with a much bigger, grander event where we have actually spread the National Taxation Awards and TIOL Tax Congress over 2 days instead of one. And let me tell you that it has taken a whole lot of more effort on the part of the TIOL team to do that. So can we just have a round of applause for the team that's worked so hard to put these 2 days together? So today is day one, that is the TIOL Tax Congress, where we will be constructing thought leadership in the finance and fiscal space. And of course, that requires deliberation on a lot of serious and technical issues. So there are a lot of panel discussions curated specially to cater to that. And tomorrow, at the National Taxation Awards, we will get together once again to celebrate and acknowledge model taxpayers, and hopefully by doing that, encourage and motivate others to do so. Without further ado, let's get started with the agenda of the day. We are extremely honored to have with us today some very distinguished personalities at the Congress. I request our honorable guests to please join us on the stage, and I would like to request TIOL team to please formally welcome them as they come onto the stage, starting with Shri Garg, a recognized GST and service tax expert, well-conversant with global models, a distinguished former IRS officer with extensive experience with government and private sector. Not just that, a winner of the prestigious President of India Award. Thank you so much, sir, for making time out for the TIOL Tax Congress. We are honored to have with us this morning Dr. Bibek Debroy, a renowned Indian economist and a Padma Shri awardee, serving as the chairman of Economic Advisory Council to the Prime Minister, someone who's known to have made significant contributions to game theory, economic theory, income, social inequalities, and a whole lot more. Thank you so much, sir, for joining us this morning. We are also grateful to have Honorable Justice Manmohan with us, who was designated Senior Advocate in 2003 and appointed Permanent Judge of Delhi High Court in December 2009, for joining us this morning for the TIOL Tax Congress. Thank you, Honorable Justice Manmohan. And now, ladies and gentlemen, without further ado, let's give this morning a befitting start with the auspicious lamp lighting ceremony. To carry that forward, I request all our guests to please come forward towards the lamp. And I also request Mr. Shailendra Kumar, CEO and founder editor of TIOL, and Mr. R. Sridhar, TIOL Award Committee Coordinator, to please join them. Thank you, gentlemen, for doing the honors. I request you to kindly take your seats. And before we proceed further, I would like to request TIOL team to please come on stage and present them with the token to welcome them to the TIOL Tax Congress. A big thank you to our esteemed guests for making time out of their busy schedules and joining us this morning. Thank you. Thank you, TIOL team. And now, ladies and gentlemen, it's time for me to invite onto stage Mr. Shailendra Kumar, Trustee of TIOL Knowledge Foundation and the man behind the very vision of TIOL, to please welcome our august guests. Mr. Shailendra Kumar.
Good morning to all. On this occasion of 3rd TIL Congress 2022, I extend a very warm welcome to Honorable Justice Manmohan, Dr. Debroy, Mr. Bibek, some of the members of the Honorable Jury, some of the senior serving and former officials of the Government of India and state governments as well, my friends from Corporate India, TIL team, the awardees who are around, I can see some of them here. I think most of them will be with us tomorrow. Ladies and gentlemen, let me start with my observation very briefly, because all of us are here to hear the dignitaries on the dais, and particularly the vision which Mr. Garg is going to share with us, that the canvas of taxation by 2047, presentation we will have very soon. But briefly, I would like to make some observation. And let me start with this economic bloodbath which the global economy is subjected. The sparks it had regained post-COVID-19 has dimmed again. Generally speaking, energy is life, but its skyrocketing prices worldwide, in fact, it has put the entire global economy on the edge. More jittery times, I see clearly, lie ahead of all of us. The emerging economies in particular will face very challenging times because it will directly wreck their forex kitty. And that is where the real challenge lies for most of the emerging economies to deal with this emerging crisis of inflation and so many factors which we have seen in last few months, in fact. And the rising energy cost, it has fueled inflation in almost half of the global economies. And what is more interesting from taxpayers' perspective is the tectonic shift in the approach of modern governments to grapple with this particular polycrisis. I see this as a polycrisis. And no crisis is new to this world, all of us know. However, that political approach to deal with a particular state of problems or a crisis which is emerging rapidly, that is where we see a lot of innovation and creativity in the approach of the modern governments. Before I talk about how, let me transport you back to 1973-74. It was not just a grim winter, but grimmer were the energy prices, very similar to what is enveloping the global economy today. At the height of the crisis in 73-74, the German Chancellor, Willy Brandt, his official response to the crisis was, for most of the common households, quote, "We all have to get dressed a little more warmly this winter, maybe in the next, and maybe 3 winters," unquote. In other words, the government a few decades back were not willing to announce any bailout package at the cost of the fiscal health of the treasury. Those days, the governments were largely tight-fisted, a complete no-no to splurging of tax revenue. That was the scenario a few decades back. Now let me take you back to 2022. What is happening now? Let us now visit how politically savvy the modern governments have become today and how enormously lucky we are that we are living in the present era of bailout packages. Government across the world, including the emerging economies like India nowadays, do not think twice to extend fiscal cushions to hard-hit, not only individuals or households, but also virtually all the sectors of the economy. Such a radical shift may be analyzed in 3 broad phases. The first phase the way I look at is that the financial crisis 2007 to 2009, when most of the government cushioned the crumbling financial institutions by generously doling out financial assistance in terms of billions of dollars, and they have survived. Then comes COVID-19, which nudged the rich as well as not so rich economies to provide economic stimulus packages which amounts to about 17% of the global GDP. That in terms of $1 trillion, it makes about huge amount, 1,700 billion or so. Now the third phase began after the Russian invasion of Ukraine, jockeying up the energy prices, along with several other food commodities, etc. And to deal with this crisis, the governments are busy policing bailout packages. Only 10 days back, the government of Japan unfolded a package just to deal with inflation, $200 billion package. Where will all such resources come from? That is the question. That is the larger question. And of course, as per my understanding, nowhere but the taxpayers. So governments of course have the rights to tax citizens, but the taxpayers also have the right to demand simple tax laws, easy compliance, better taxpayer services, reinforcement of mutual trust between tax administrations and taxpayers, and to top it all, a bout of fiscal contemplation to improve the system against the rapidly emerging digitalization worldwide. This is what TIOL Knowledge Foundation intends to facilitate: a national discourse over taxes, not to generate heat, but to throw some light, provide some new insights to the world of policy making and also the tax compliance, a peep into the dynamically evolving blockchain and AI-driven tax tools, promoting automated compliance across the board. In fact, across the canvas, we see the technology is being adopted in a big way, and the big data, how it is yielding new insights, not only for the revenue and the tax administration and policymakers, but the taxpayers as well, and also in corporate planning. And also, we are looking at all these inputs, to what extent it spurs investment in the economy. So our efforts are to encourage a new culture of economic and fiscal thought leadership in partnership with all the stakeholders. And this is what the distinguished panelists are going to do today in our 4 technical sessions, which we have later today. I reiterate that TIOL Knowledge Foundation is a forum to reflect on what has been done so far by India and as an aspiring economy, and what more needs to be done in the coming years. This is also an occasion to examine the fiscal relationship of the citizens with the state. That's very important, that as a taxpayer, we set up form some kind of nexus with the state, and how a state responds to the issues and the challenges of a taxpayer. So we also try to promote that the taxes affect both, at the same time, equity and efficiency of the economy. Taxation is not only about raising revenue, but it also demonstrates a society's judgment about the counts as a society's judgment about what counts as a precious contribution to the common good, to the public good. I believe the tax policies for freer and fairer country like ours has to be different, and all of us have assembled here today to deliberate on the same. With these words, I once again thank all the dignitaries on the dais and the distinguished speakers for sparing their valuable time to enchant and enlighten the audiences present here. Thanking you all. Thank you, Shri.
Thank you, Mr. Shailendra Kumar, for that opening to the Tax Congress. And now, ladies and gentlemen, who better to give the opening address of this Tax Congress than the man who has a 360-degree exposure to taxes both at state and central level, dealing with customs at a global level and then going on to advising corporates. We're talking about Shri V.K. Garg. I request Shri V.K. Garg to please come on the dais and open this Congress with a special address on Canvas of Taxes by 2047. Let's welcome him with a round of applause. Welcome, sir.
Good morning, friends. Honorable Justice Manmohan, Dr. Bibek Debroy, my dear friend Shailendra, entire team of Tax India Online, my colleagues, erstwhile colleagues from CBIC, officers, other officers from central government, state governments, representatives from corporates, ladies and gentlemen. I must say that the topic that Shailendra asked me to speak about is a little intimidating, even to me, after serving 40 years in various capacities in the tax department. Let me start my talk with a little anecdote from 1942. Albert Einstein had given an exam to senior physics students at Oxford. His assistant asked him, "Isn't it exactly the same exam which you had given last year to the same class?" "Yes, yes." "Well, the answers have changed this time." So what was true in 1942 is far truer today. The rate of change over time has become far steeper than ever before. When we see changes over a shorter spans, we are often constrained by boundaries which may be constitutional, political, technological, or economic. But when you think decades ahead, most of these do not remain boundaries or constraints. We know Elon Musk is talking of placing 1 million people in Mars by 2060. Yuval Noah Harari, I am sure most of the people would have heard about him, famous author of Sapiens, which has sold millions of copies and translated in 65 languages. He believes that humans may cease to exist in 100 years, replaced by AI-enabled robots as new species, entirely being capable of multiplying on their own. Whatever be the credibility of such projections, it is widely believed that the next 25 years would see change somewhat equivalent in quantum to what has happened over the last 100 years. So I tried to spend some time on the field of taxes, how they existed immediately after independence. Total all India tax collections, both central and state governments, after independence were just about 500 crores. Now we are projected to collect nearly 42 lakh crores during 2022-23, which is 8,000 times of the money that India collected immediately after independence. Even if you adjust this number for inflation, the increase is more than 200 times. Now all this revenue has come with one of the lowest tax rates in the century. Top marginal rate of income tax was close to 98%. I repeat, 98% in 1973-74. Average customs tariffs till 1990 were 4 to 5 times of present. There were no tax credits in central excise for the first half of the last 75 years, and in sales tax, VAT was introduced only in 2005. GST, as you know, is still trying to find its teeth. Now, if this talk was being held in 1950 or 1975 or even in 1990, I doubt anyone would have made the projections anywhere close to where we stand today. I thus approach the subject with great humility, attempting to touch very briefly on sub-key trends. Clearly, a 15-minute presentation can only touch the surface of the subject. Now let me open the innings with the first trend that I wish to talk about, that is the rising public debt. The aggregate debt of Indian states has reached a 15-year high of close to 32% of the GDP. Some states are hovering at a precarious level of 40% or even 45%. RBI has flagged 5 states that are at dangerous levels. The debt burden of the center is also rising. The recent economic crisis in our neighborhood and some other countries is a stark reminder of the critical importance of keeping public debt within sustainable limits. One has to learn to optimize what I call the trinity of how much to borrow, how much to spend, and how much to tax. GST compensation has not only dried up, but the future GST compensation stands committed to repay the amount borrowed to pay the previous shortfalls. The worst impacted states are already facing a crunch in the range of 30 to 35% of the GST's assured revenues. Now, with freebies gaining center stage, this is likely to place significant pressure on center to help states bridge the gaps. Now, recognizing the limits to getting revenue only with improved compliance, I feel governments will face pressure for newer taxes or higher taxes, including allowing very high deficit states to impose GST at relatively higher rates than the national average. Many states, I've already witnessed, many states have already started levying fee and charges for the provision of many services, levying such fee more like taxes. Now, there are questions regarding the constitutional validity of such fee and so on and so forth. So these will keep courts and taxpayers and tax authorities sufficiently engaged in times to come. Next trend that I would like to talk here is the changing demographics. It is estimated that the old age dependency ratio, which is defined as the number of people aged 65 and above as a percentage of number of people in the age group of 20 to 64, will jump by more than 50% in the next 25 years across major countries of the world. India presently enjoys a relatively better demographics, but our number would double in the same period due to the low base. It is well known that consumption tends to peak when people are middle-aged, while it is lower for older people, and as they consume far less durables, which pay higher consumption taxes. Moreover, the incomes of older people suffer far lesser income tax. This creates pressure to raise tax rates on rest of the population, though it may not be advisable to meet the entire gap from higher taxes. It is usually tough to increase the rates of personal income tax, which has far more serious effects on labor markets and investments. The burden thus falls elsewhere. To take the example of Japan, that has one of the highest populations above 65 years amongst major countries, which is about 30%. Now, they started their VAT sometimes in 1989 with a rate of 3%, which was increased to 5% in 97 8% in 2014, and 10% in October 2019. Next trend that I would like to talk about is the climate issues. Now we are aware that the world has committed to net zero emissions and India has committed to net zero emissions by 2070 and achieve 50% of that target by 2030. Now with the tapering off of fossil fuels, one of the major sources of taxes from petroleum and coal, constituting presently nearly 25% of all state taxes and about 17% of all central taxes, will start declining, gaining considerable momentum by the end of the next decade. That will create pressure to augment taxes from other sources. Now, even though electricity is a part of the GST, it is presently fully exempt, allowing states alone to levy electricity duty. Its exclusion from GST adds to considerable cascading, denting India's global competitiveness. India needs and should see a GST regime to include at least environmentally friendly electricity in GST, supplementing taxes lost on fossil fuels from alternate sources of energy. Next trend I would like to briefly mention is the impact of security issues. International trade is now much more complex, with countries increasingly using trade tools to force rival countries to accept their political or economic demands. This is known as trade weaponization. The US-China trade war in the last few years exemplifies this trend, escalating with almost no influence of the World Trade Organization. The United States has publicly treated many companies of China as threat to national security. The primary tools implemented in the trade wars are the customs tariffs and trade restrictions. Free or preferential trade arrangements are entered into with countries as a means to negotiate larger strategic interests with aim to dent the economic and thus the military might in the desired directions. We have seen North Bloc and Udyog Bhavan increasingly being guided by the South Bloc on such issues, a trend that is likely to become far steeper in future. The next trend I wish to talk about is the formalizing of the economy, in which taxes are both a contributor as well as a beneficiary. Now, we have seen in the past many years that TDS and TCS in income tax have already made significant contribution in this area. In GST, tax credits can now only be claimed if the particulars of the suppliers are validated, making it much tougher not only to evade GST, but also to carry out illegal transactions. The rapid adoption of Aadhaar, UPI, Jan Dhan, and electronic platforms for commerce is forcing a vast informal cash economy into formalization. These electronic commerce operators are being subjected to TCS in GST, establishing a trail that can help track persons who earlier remained under the tax radars. When food platforms like Zomato and Swiggy were made accountable last year for payment of GST for food delivery by individual restaurants, it brought massive formalization of such restaurants, with accounted sale increasing up to 50 times in certain cases. In many sectors, profit margins are tax evasion. Such businesses are increasingly shutting down. As per Ministry of Corporate Affairs, nearly 4.5 lakh companies shut down during the first 3 years of GST, an unprecedented number. This is also evident in the corporate tax collections rising by close to 24% and GST by 33% in the first half of the current financial year. Fewer and fewer entities are contributing far bigger share to profits and taxes. In the United States, the top 100 firms accounted for 84% of the combined earnings of all listed companies. This figure was just 49% in 1975 and 53% in 1995. Now, this may raise fresh issues, including whether we need to collect taxes, particularly like GST in the present form, from crores of taxpayers, and whether the kind of compliance mechanism that is designed for one hat fits all is needed going forward. I would expect to see AEO, which is authorized economic operator kind of system that is prevalent in customs, working in GST over the next few years. The next very important trend is digitalization. Now, if India has to meet its ambition of reaching a $20 to $25 trillion economy by 2047, we would need to be hyper competitive and save on all costs that do not add intrinsic value to a product or service. Cost of tax compliance is one such cost. Tax compliance in future will be like self-driving cars based on algorithms and design systems, freeing up drivers' attention to concentrate on business. Going forward, billions of packages will be sent out for delivery using drone, robot, or autonomous vehicles. If anyone believes that e-way bills, tax return, searches, and seizures will survive a lifetime, he may not be thinking even a decade ahead. Automated tax systems relying on advanced data analytics will know so much about economic participants that evading taxes and hiding wealth would become extremely difficult. Blockchain, digital currencies, artificial intelligence, and robotics-based solutions will apply to a large number of existing problems, helping predictive working, including automated filings and verifications. Even though facing a robot judge sounds like science fiction at present, many envision this as a part of next set of possibilities in administration of justice. These technologies already facilitate justice delivery in many countries like China, Singapore, the United States, and the United Kingdom. Artificial intelligence automatically screens out cases for the purpose of reference, recommends relevant laws and regulations, drafts legal documents, and alters perceived human errors in a judgment. At least the problem of revenue-biased show cause notices in tax laws can be addressed through such AI techniques, restricting demands unless the machine validates the proposed notice by a desired minimum rating. A few words on the convergence of taxes. Now, taxes are essentially of three kinds: on consumption, on income and wealth, and as tariff barriers. GST, you know, is a consumption tax on goods and services. Now, the distinction between goods and services is fast diminishing. Already, cooked food, construction sectors are defined in GST as services, and many intangible supplies are taxed as goods. Going forward, more and more goods will be traded as services. For example, instead of owning one specific vehicle, one might buy a subscription package that gives him the option to drive different cars as per his liking at different times. There is a case to treat services no differently than goods, including in matters related to customs. The case for subsuming various consumption taxes into GST, various taxes outside GST into GST will continue to beg serious consideration. I also wish to raise a larger issue. Is there a fundamental difference between income tax and GST if income inequalities are taken care through direct benefit transfer? After all, income tax is a tax on profit, while GST is a tax on the same profit plus finance costs plus labor costs. Similarly, is there a fundamental difference between GST and customs? GST includes transfers across state borders, while custom is a tax across international borders. GST tariff is already based on customs tariff. I see massive scope for convergence amongst all these taxes, or at least tax laws, including the possibility to have just one tax in future collected equally between center and states. This can start with a common tax code on operational issues. As I am reaching the end of my talk, I wish to raise another important question. Where does all wealth come from? Some may say taxes. However, if you tax Peter to pay Paul, it is a zero-sum game. All wealth comes from science and technology. The wealth in the first industrial revolution came from inventions in thermal dynamics that created heat engine, the industrial revolution, and produced the likes of Rockefeller. The next wave produced electronics, and the new Rockefellers were the likes of General Electric. The third wave brought computer and internet and produced new wealth creators like the FANG companies. What are going to be fourth and fifth industrial waves? Fourth wave has just started and concerns advancements in artificial intelligence, nanotech, and biotech. Heroes of this area are not created yet. The fifth wave, which will start in another 25 years or so, is expected to bring fusion power that will bring machine-brain interface and what is called as digital immortality. It is well impossible to project tax scenarios for these technologies. Suffice to say that some of the people who would be dealing with these are present in this room. While new technologies would bring lots of value, it would not come without its own share of challenges, some of which might need new taxes. World is already debating robot tax to be levied when you replace a human worker with a robot to incentivize human employment and creating resources for reskilling or as means of livelihood for those replaced. Now, if future sounds like science fiction movie, you are probably wrong. But if it doesn't sound like a science fiction, you are definitely wrong. I hope deliberations to follow will help us to find a clearer path on some of the issues that I have raised. I see tremendous potential in TIOL to continue to create tax awareness of a very high order in times to come and ignite interested minds to serve our nation far better. I wish them success in every possible way. Thank you for listening me patiently.
Thank you so much, Shri Garg, for diving into your rich experience and sharing such deep insights with us. Moving forward, ladies and gentlemen, we would like to now invite onto the dais Chairman of Prime Minister's Economic Advisory Council, Dr. Bibek Debroy, to please join us for a special address. Dr. Bibek Debroy.
Honorable Justice Manmohan, Mr. Garg, ladies and gentlemen, let me start by thanking TIOL Tax Congress for having invited me here. As has already been announced, I have an official hat. But Mr. Garg has set the template for 2047. So therefore, anything that I say should not be interpreted as indicative of what the Economic Advisory Council has recommended to the Prime Minister or as indicative of what is likely to happen in the forthcoming budget. These are my comments as a citizen and my comments as an economist. Let's start with the big picture. And what is the big picture? The big picture is, as citizens, all of us expect government to deliver various public goods and services. I'm not using the word public goods and services, the expression public goods and services in the sense in which an economist uses it, which is a very specific sense. I'm using the expression public goods and services in the sense that these are things that we expect the government to deliver, perhaps even provide, perhaps even subsidize, because the private sector is not going to do that. And we will have a long list if we go around this room of what the government should be doing. It will be physical infrastructure, roads, railways, other forms of transport. It will be social infrastructure, health, education. There is a completely different question not linked to this Congress, but I will just mention it. There are issues of the level of government that delivers these public goods and services. Because most public goods and services that are not delivered by union government, they are not even delivered by state governments, they are delivered by local governments. So there's an issue of decentralization and fiscal devolution, which is not just union government, it is also within states, from the state governments to local bodies. But leave that aside. All of us as citizens would like to see railway stations like the ones we see abroad, airports like the ones we see abroad. But to deliver these, the government needs the resources. And the primary source of resources for governments is taxes. Let's just add up the various demands we have as citizens. Oh, the government, when I say government, I mean governments in all of its three layers. Oh, the government must spend 6% on education as a percentage of GDP. It must spend 4% on health, 6 plus 4, 10%. It must spend 10% on infrastructure, 10 plus 10, 20%. It must spend 3% on defense, 20 plus 3, 23. We are already at 23% of GDP. Today, the tax collection, union and state combined as a percentage of GDP is just around 15%. So the government has a kitty of 15%. Our demands are 23%. So obviously something has to give. When we are talking about taxes, we are either talking about direct taxes or we are talking about indirect taxes. Let's look at both of these individually. First, the GST. The GST has been phenomenal work in progress. It is a remarkable instance of union government and state governments working together. When the GST was first announced, there was an estimate that floated around, and that estimate said that GST would lead to 1.5% to 2% increment to GDP growth. It was widely quoted. What was not widely quoted was that estimate done by an organization known as the National Council for Applied Economic Research, NCAR, was based on the premise that all goods and services would be part of GST. All goods and services would be part of GST, and there would be a single GST rate. I need not belabor the point about all goods and services not yet being part of GST. Mr. Garg has already mentioned one of those items. But as a polity, we need to take a call on whether we accept there should be a single GST rate or not. Everyone's mindset is one of trying to control and influence. So we decide this particular item is elitist in nature, so the GST rate on this must be higher. This particular item is an item of mass consumption, and therefore the GST rate on that should be lower. The moment we accept this mindset, we allow for differentiation. The moment we allow for differentiation, we allow for subjective interpretation. We allow for litigation. And it is therefore my submission before you that as a polity, we need to recognize that the GST rate should be the same regardless of the product. If progressivity is to be introduced, that is best done through direct taxes, not GST, not indirect taxes. I'm sure several of you have traveled in Europe, and you may have noticed, in some countries in Europe, you may have noticed that the frontage of houses is very narrow. The back is fairly wide, so that if you are going to lug up furniture onto a higher floor, it has to be done through the windows. Now, why is that? Because at some point in history, it was decided that the frontage of a house captured how rich a person was. And therefore, the tax was linked to the area in the front. And naturally, people did what they would always do. They bypassed it. You will notice, particularly in Britain, some of the old houses are very dark. The reason they are dark is at one point in time, windows used to be made out of glass, and it was perceived that glass was an item of elitist consumption. So there was a tax on glass. You did not want to use glass. And therefore, you had smaller windows. But let me not digress too much. On GST, it is my submission, therefore, there should be a single rate. I don't think we'll ever get it, but my submission is that is what we should want. The tendency of every person is to say, remove exemptions, but remove exemptions for everyone else. Please retain exemptions from me. That way, tax simplification does not. When GST was introduced, there were some estimations that were done by the Department of Economic Affairs, and those established that the revenue neutral GST rate, the average rate that would give us the same revenue as pre-GST, that revenue neutral GST rate was at least 17%, if not more. What is the average GST rate today? It's 11.5% or even lower. So on GST, the simple point, reinforcing the broader point that I made, we must be willing to pay higher taxes. Or we must be willing to settle for reduced delivery of public goods and services. Every year, the budget papers have a statement known as revenue foregone. This is revenue that government gives up because of exemptions. Depending on the year, it amounts to 5 to 5.5% of GDP. So the moot question is, should those exemptions at all be there? Let me now quickly come to the question of direct taxation. A lot of improvements have happened. The number of people who submit tax returns has gone up dramatically, as all of you know. The number of people who submit tax returns has gone up dramatically. Does that necessarily mean that all these people who submit tax returns are actually paying taxes? Not necessarily. There is a difference between tax evasion and tax avoidance. Of course, there is tax evasion, and there's been a clamping down on tax evasion. Tax evasion is illegal. Tax avoidance is when you use exemption clauses that exist to reduce taxes. And tax avoidance is perfectly legitimate. The moot question that therefore arises, reiterating a point that I made earlier, is, do we need these tax exemptions? The more tax exemptions I have, the more complicated it becomes. The more I need a CA, the more I need a lawyer, the more there is litigation. Why can't we have a simple tax structure devoid of all exemptions? Yes, today, both on the personal income tax side and on the corporate tax side, there is a scheme, not mandatory, of opting for an exemption-less regime. In my view, not an official EACPM view, in my view, this is like jumping a ditch. You cannot jump a little bit of the ditch and hope to jump the rest of the ditch later. We must at some point agree we will move to a completely exemption-less system. If we move to a completely exemption-less system, it is right to ask, why do we have this artificial difference? Mr. Garg said something similar. I'm making a slightly different point. Why do we have this artificial difference between corporate taxes and personal income taxes? A lot of business, unincorporated business, pays taxes under the personal income tax route. If we do this, I think we will also reduce the administrative costs of compliance. I have not made some points because of paucity of time, obvious points about the nature of appeals, about the unnecessary litigation that departments indulge in. But if we are looking to 2047, in terms of transparency, this is what I think we should be looking towards: a completely simplified, unified, harmonized, streamlined, direct and indirect tax regime. Thank you very much.
Thank you so much, Dr. Bibek Debroy, for that address. And now moving on, it's time for us to invite for the inaugural address of this Tax Congress by the chair, that is Honorable Justice Manmohan, Judge High Court of Delhi. I request you to please join us on the dais and deliver the inaugural address. Welcome, sir.
Respected Dr. Debroy, Mr. V.K. Garg, Mr. Shailendra Kumar, ladies and gentlemen, a very good morning. It's a very difficult act to follow, Dr. Debroy, but I'll make an effort. See, the completion of a century of direct taxes, 1922 to 2022, is perhaps a good time to pause and reflect on the years gone by and to examine whether there are critical lessons that one must learn for the future. Our generation has seen technological changes at a very fast pace. In just 3 decades, the computers, the mobile phones, the internet have transformed every facet of our life. It is but inevitable that our legal system, including the administration and adjudication of taxation, must adapt itself to meet the challenges of the increasingly digital and electronic world. The Indian Income Tax Act 1922 was in operation for about 40 years before it was replaced by the Income Tax Act 1961, which recently completed its Diamond Jubilee. In fact, the levy of income tax in British India was made for the first time in 1860 to meet the financial difficulties that arose out of mutiny of 1857. These were different taxes, but a regular income tax was first imposed in 1867. It was short-lived for 5 years. A proper levy of income tax was made in 1886, which was then replaced in 1918, when for the first time 6 heads of taxation were introduced. An All India Income Tax Committee was formed, and on its recommendation, the Indian Income Tax Act 1922 was enacted. The working of this act was examined in detail in the 12th report of the Law Commission 1958. Another committee called the Direct Taxes Administration and Inquiry Committee also submitted its report in 1959. Based on these recommendations and to streamline numerous amendments that had been made in the 1922 Act, the present Income Tax Act 1961 came into force. Keeping in mind the numerous amendments that have been and continue to be made in the 1961 Act, it is perhaps impossible to expect any tax law that is simple. In the introduction to the first edition of Kanga and Palkiwala's book, known as The Law and Practice of Income Tax, it was stated that in the law of income tax, the main principles are fairly simple, but the whole difficulty arises in their application. What was stated in the 1950 continues to be true to this day. Over the last century, the important issues that have arisen for consideration before the legislature and the judiciary have changed considerably. For instance, in 1947, a levy was made on capital gains for the first time, and this led to a substantial amount of litigation as to what amounted to transfer of property. Immediately after the introduction of the 1961 Act, the litigation was primarily focused on what constituted income, the difference between a revenue and a capital receipt, and expenditures that were allowable as deductions. It is significant to note that now several other branches of law have developed through the judicial rulings on income tax. In fact, in the Madras Bar Association case in 2014, the Supreme Court noted that as many as 12 branches of law had to be taken into account while deciding the tax-related disputes. These included personal law, company law, contract law, and laws relating to property, trust, societies, and intellectual property. With the increased expansion of international trade and commerce after the Second World War, the taxation of cross-border transactions became a critical challenge for both Parliament and courts. It is a fundamental rule of international taxation that every nation has a sovereign right to impose tax on the global income of its residents and on income that accrues or arises within its territorial limits. These twin rights are referred to as the residence-based or source-based taxation. Once again, there is little difficulty in deciding whether a particular income actually accrues or arises in the territory of India. The challenge starts when deeming fictions are created and income is deemed to accrue or arise in India under various situations which are set out, for example, in Section 9 of the current Act. Thus, what amounts to business connection, what is royalty or fees for technical services, continues to be the subject matter of extensive litigation. A combination of source and residence rules inevitably led to double taxation. And this, in turn, led to signing of numerous double taxation avoidance agreements, which are bilateral treaties that enable tax being levied in any one of the contracting states. The double taxation avoidance agreements unfortunately led to treaty shopping. According to experts, treaty shopping is a graphic expression used to describe the act of a resident of a third country taking advantage of a fiscal treaty between two contracting states. The beginning of the present century saw numerous measures to include in the tax net income which arose out of business activities, not necessarily in India, but out of activities that had economic nexus with India. An example is transfer pricing, where rules were framed to ensure that transactions between associated enterprises were at arm's length and there was no underreporting of income in India. This branch of the law grew rapidly as well. But the digitalization of the economy and increase in cross-border trade required a far more comprehensive response from the international community, as under the existing law, different countries impose different corporate tax rates on multinational companies. As a result, multinational enterprises tend to locate in lower tax jurisdictions to minimize their tax burdens and treat more or all of their profits as sourced to that country, bringing down their effective tax rate or ETR. This led to increased tax revenues in countries with lower tax rates and decreased revenues in countries with higher rates. These tax strategies are called profit shifting and result in base erosion in countries with higher corporate tax rates. These strategies are also called by some experts as smiley transactions. Smiley because the multinational enterprises have the ability to shift their profits to any end of the smile. India alone loses billions of dollars in taxes annually owing to global tax planning by multinational enterprises. The first major international response to shifting of profits came on February 12, 2013, when the Organization for Economic Cooperation and Development, OECD, involving the G20 countries, published its report on base erosion and profit sharing, popularly known as BEPS. In 2015, the OECD released 15 action plans, which came to be known as BEPS 1.0. These action plans were based on the premise that fundamental changes were needed to prevent double non-taxation, as well as cases of no or low taxation associated with practices that artificially segregated taxable income from the activities that generated it. For instance, to deal with treaty abuse, the G20 BEPS project required countries to adopt at the minimum rules designed to ensure that only true residents qualify for treaty benefits. These included various combinations of limitation of benefits called the LOB rules, which were a specific type of anti-treaty abuse rule, and or the more general principal purpose test, PPT as it is called, and amendments to tax treaties to specifically state that their objective was to prevent double taxation and not facilitate treaty shopping. The important changes that were introduced in India on the basis of BEPS 1.0 were: 1. Equalization levy to address the tax challenges of a digital economy. 2. Thin capitalization rule to limit the allowance of interest expenditure on companies and permanent establishments. 3. The place of effective management, or POEM rules as they are called, which deemed a non-resident company to be a resident depending on where the key management and commercial decisions were taken. 4th, the concept of significant economic presence, by which a non-resident company was deemed to have a business connection in India. Consequently, if the aggregate amount of business during the previous year by a non-resident exceeded the prescribed limit, the non-resident was deemed to have a business connection in India with consequent tax liability. Apart from India, several countries in pursuance to BEPS 1.0 started taxing whole or part of the income that arose on account of economic activities that had a relation with that country. Thus, novel or unilateral measures such as digital service tax, diverted profit tax, multinational anti-avoidance law, overseas receipt in respect of tangible property were introduced. This led to protests from various countries. The aforesaid measures represented the first substantial revamp of the international tax rules. However, these measures did not completely iron out the concerns of a digital economy. In fact, the main concern of the governments all over the world continues to be the shifting of profits and advent of new technologies, which permits big companies to do business without any physical presence in a country. It has been widely reported in social media and newspapers that Facebook's UK operations paid a mere euro 29 million in corporation tax last year, despite reporting a record euro 3.3 billion euros in sales. The social media company's latest accounts for its London-based arm showed gross income from advertisers surged by more than 37% last year, from euros 2.4 billion to euro 3.3 billion. The company paid euros 29.8 million in UK corporation tax last year, down on the euro 36.7 million it paid the year before. Needless to state, this led to a furore. Further, when the concept of permanent establishment was introduced in the 1860s, little could one imagine anything other than a physical presence. With the advent of a new age technology, the concept of virtual presence has gained significance more than ever before. Over the years, as the term permanent establishment has evolved with time and has found new dimensions with judicial interpretations, one can safely vouch that it has become incapable of taxing digitalized economy fully. To meet these challenges and to ensure a coordinated and consistent approach, OECD broadened its BEPS discussion to include more than 140 countries through a platform called Inclusive Framework. On 1st July 2021, of the 141 members of OECD G20 Inclusive Framework, 137 signed on to the statement that set forth the key terms for a two-pillar framework to overhaul the international tax rules. This phase of BEPS is known as BEPS 2.0, and it takes forward the unfinished agenda of BEPS 1.0. Pillar 1 of BEPS 2.0 seeks to expand taxing rights of market jurisdictions. That means the countries in which the goods or services are purchased or consumed. It reallocates 25% of global profits in excess of 10% of global revenue. That means 25% of residual profits of multinational enterprises having a global turnover above euro 20 billion to the jurisdiction where the markets are. Consequently, Pillar 1 is quite path-breaking as it does away with the concepts of permanent establishment, arm's length price, single entity principle, necessity of physical presence, and recognizes a group entity. There is a proposal to reduce the global turnover threshold of multinational enterprises from euro 20 billion to euro 10 billion 7 years after Pillar 1 comes into force. Pillar 2 introduces a global minimum tax of 15% for affected multinational enterprise groups via the global anti-base erosion model rules. If an affected multinational enterprise has an ETR of less than 15% in tax havens at the group level, other jurisdictions can top up tax equal to the difference between the taxpayer's ETR and 15% minimum rate under the income inclusion rule. Though a political agreement has been received from 137 countries, the framework still needs to be delivered on a country-by-country basis. According to an estimate by the OECD, Pillar 1 could see over $100 billion reallocated to the market jurisdictions, like India, while Pillar 2 may help generate more than $150 billion in new tax revenues globally. Many experts also believe that most forms of equalization levy and unilateral measures will go away once Pillar 1 is implemented. The outcome of BEPS 2.0 is expected to be good for most nations. Pillar 1 of the BEPS 2.0 model has been described by many as a fundamental reallocation of taxing rights after the 1920s. Many experts believe that India has participated very actively in BEPS 1.0 and 2.0 as the country has realized that century-old tax principles are no longer fit for the 21st century economy. While the changes in international taxation will certainly have far-reaching consequences, the changes that have taken place in our tax administration have been of no less significance. For the first time, assessments are now completed in a faceless manner, and even the first appeal to the Commissioner is faceless. These statutory provisions seek to employ artificial intelligence in the hearing and disposal of assessment and appeals. It will be interesting to see how effective the new system is. Information sharing arrangements between India and other countries has vastly improved, and these arrangements ensure that the Indian tax authorities automatically receive information of Indian residents who have assets in foreign jurisdictions or information about multinational enterprises allocating profits abroad. The executive must ensure that there is trained manpower, sufficient systems, infrastructure, and capabilities to analyze such information to reap the true benefits of this flow of information in a timely and focused manner. There is also growing need for the Indian tax administration to balance its efforts to collect taxes while at the same time recognizing the need for India to remain the favored investment and FDI destination. While BEPS 2.0 may reduce the room for tax competition among countries, it does not reduce competition for investment. We will need to strengthen non-tax factors and reinvest to stay competitive in a post-BEPS 2.0 world. Certainty, consistency, transparency, uniformity, accountability, and a broader consultative impact analysis for changes in law should be the touchstone for changes in tax policy. We must, however, not forget that there are certain universal and timeless principles that will always prevail. The famous dictum of Justice Rowlatt, that there is no equity about tax, is not entirely true. There may be no equitable consideration when a statutory provision is clear, but equity, fairness, and justice have vital roles to play in the implementation and the administration of any tax system. After all, taxation is only a means to an end of economic development of any nation. It cannot be an end in itself. Equally important is the role of tax professionals who must shun artificial devices and any kind of planning that amounts to tax evasion. It is hoped that in the years ahead, the Citizens' Charter is implemented in letter and spirit by the Tax Department, and that the assessees and tax professionals are equally mindful of their duty of being honest taxpayers. Only then we will be able to thrive with steady economic growth and good jobs. In conclusion, I would like to say that we are living in interesting times. In fact, challenging times. If international tax systems change only once every 100 years or so in a significant way, then it is happening now. You're all blessed that you have the opportunity to participate in this extraordinary change. It is a challenge and an opportunity which requires a nimble-footed response. Thank you very much.
Thank you, Honorable Justice Manmohan, for delivering the address. And now I request the dignitaries to please come forward as we're moving into the release of TIOL's special print publication, 5 Years of GST, The Buggy Trucks On. As the title explains, it's a publication on 5 years of GST, and we've tried to put a lot of articles from more than 40 top indirect tax experts, not just from India, but from across the world. I request the guests to please come forward on the stage, and I also request Mr. Shailendra and Mr. R. Shri from TIOL to please join the dignitaries for the release. That's TIOL special print publication, 5 years of GST, The Buggy Trucks On, getting released. Make sure you pick your copy of this book from the registration desk in the tea break that's coming ahead. Don't forget to do that. Thank you to all the guests. I request our guests to please be seated back. And if I could request Mr. Sridhar to please stay back on the stage, the TIOL Award Committee Coordinator, I request him to please deliver the vote of thanks for this session.
Good morning, once again on behalf of TIOL. And what an absorbing opening session. I think an applause is due for the cross-section of views you've heard of the last 1.5 hours. And just to recap, I can't recap the number of views that was there. I just did my best to note it down on my iPhone. We had Mr. Garg right from the word go, his views on what were the current fiscal landscape, what is the impact of the center-state debts, the overall impact on revenue governing when there is an aging population, impact of environment, fossil fuel taxes, you name it. I mean, it goes across the spectrum. Formalization of economy, how it will look after 2.5 decades, digitalization, role of artificial intelligence. Can we converge into one tax, which was exactly the theme that we wanted from thought leadership, which is exactly what was delivered this morning. And how will the fourth and the fifth industrial revolution, which is underway and which is expected in the next 10, 15 years, impact all this on a macro basis? So we moved on from this session. We moved on to Dr. Bibek Debroy. I mean, I must say one important point that I learned from this morning, that public goods and services can only be in concomitance with the collections on board. So that's a very important point. And what are citizen expectations, and when will citizen expectations on public goods and services be perhaps catered, and what are the conditions for it, and why we should not keep going on board to always ask for my products or my services to be exempt. A very nice lesson. Finally, we had Justice Manmohan. I mean, it was a very enlightening, perhaps, to say what BEPS 2, BEPS 1 and BEPS 2 can do to the whole landscape of tax thought. Mainly important is what will happen when there is no fair share of taxation, which is exactly the point, the whole thing that is relevant for the future. And last but not the least, it touched upon faceless assessments, the expectations of why perhaps both the revenue and the SSE should be both fair. And I mean, this I think is perhaps putting it all together, a thought leadership, not only for this decade, let's say for 2022 to 2030, the balance of the decade, and 2030 to 40 onwards. At this juncture, let me thank Justice Manmohan Ji of the Delhi High Court, Dr. Bibek Debroy, and Hon'ble Shri V.K. Garg for having consented, taken their time off from their offices, and perhaps, not only share the thought leadership, but also perhaps putting forward to the audience here what is really relevant for the next 20-25 years. Overall, this session would not be interesting without the participation of all the members of the audience, both the private sector, public sector, and the government officials. I mean, I must thank all who have taken time off and come this morning. Overall, an interesting session, absolutely illuminating. Just to make some closing comments, we'll just have a small, perhaps a photo shot, as well as a short tea break for the next 10 minutes. And then we'll come back for enlightening technical sessions that are going to be there for the rest of the day. So please be in your seats by 11:45. Thank you so much.
Thank you, Mr. Sridhar. Before we let the dignitaries go off the stage, I request the TIOL committee members, the core committee, to please come up on stage for a group photograph with them. No, no, it's all. It's okay. It's okay.